Hello and welcome to this Astranti bite-sized video. Here we have an extract from our F2 tuition video series. And in this particular video, we're going through how to consolidate group accounts and how to produce consolidated statements. A really key topic for F2 and also in the MCS exam. Okay, so let's quickly recap what we've learned so far. So control is established as a result of owning more than 50% of the voting rights of an entity, and a parent and subsidiary relationship will exist that forms a group, and the group is seen for economic purposes as a single entity. With the establishment of control, a parent will be required to produce an extra set of accounts known as group or consolidated financial statements, and the group financial statements are issued to the shareholders of the parent only. The idea is, according to IFRS 3, the basic principle is that the group statement shows all the assets and liabilities of the parent and subsidiary. So here is the basic method. So one thing we do is add together assets and liabilities. And so just to produce consolidated accounts, we combine the company's accounts by adding together the lines in the individual company's financial statements. But we do have to make a few adjustments. And one key adjustment is for investments in subsidiaries. So let's consider a simple example to see why. Now imagine you and your friend live in two separate houses, and then one day you buy your friend's house and everything in it. Now, if you add together your friend's possessions and yours, that's it. You can't also add your possessions to the amount of money you paid for your friend's house. That would be double counting. And the same is true for consolidations. You must add together the assets and liabilities, but remove the investment in the subsidiary. You don't have both. Another part of the approach is to make adjustments for equities. So when it comes to consolidations, the share capital included is the share capital of the parent only, and the reserves at the acquisition date are also that of the parent only. And another way of saying this is that you do not include the share capital or reserves of the subsidiary in the consolidated statements. Now, to consider why this is, remember what equity is. It's the net assets of the company, the assets less the liabilities. Now, to put that another way, if all the assets were sold at their net book value and the liabilities paid off, this is the amount left over for shareholders. It's actually one way of valuing a company. Does the total value of the parent company for their shareholders change just because we've consolidated the accounts? No, of course not. The value of the parent company is just the same, and hence the equity is just the same too. Another way of thinking about that is in the parent's books, we are simply replacing the investment in the subsidiary with the assets and liabilities of the subsidiary. So the equity is unchanged because it balances out to the same amount. So in summary, the acquisition method aims to replace the parent's investment in the subsidiary with what is now the parent's share of the net assets. So the first step will be to eliminate the cost of the investment and adjust the equity. So here we cancel the cost of investment, which we just added in the previous stage in the parent's books with their single entity accounts. And we also eliminate the share capital and reserves of the subsidiary. And then step 2 is to aggregate the two statements of financial position by combining the individual assets and liabilities of the parent and subsidiary. So let's have a look at how this would work in an example. So here we have P Limited and S Limited, and we have their statements of financial position. So we have P Limited's here, S Limited's here. Now P Limited is the parent and S Limited is going to be the subsidiary. P Limited purchases 100% of the shares of S Limited at par for £100,000 in cash. So it's the same example as before, but now we're producing the consolidated accounts in addition to the parent's separate financial statements. Okay, so with that information, we're going to produce the consolidated statements. So step 1, let's remind ourselves of step 1 in our summary. Step 1 is to eliminate the cost of investment. So we're going to start by eliminating the cost of investment. So that means we're going to P Limited statement of financial position. We're going down until we find the investment in the subsidiary, which is here, and we see it's £100,000, which was the cost of the investment, and this was shown in P Limited statement of financial position. So we need to eliminate that cost of investment. Now remember what I said, because we're eliminating it from here, we also need to make sure we eliminate it from equity. We can't eliminate something from assets without eliminating it also from share capital and retained earnings. Otherwise, you're not going to balance things out. So step one will be to subtract the cost of the investment, £100,000, from this line here, effectively eliminating this line from the group statements. But we're also removing S Limited's share capital and its retained earnings, which of course add up to £100,000 because P Limited paid £100,000 for the net assets of S Limited, which is this much here. That's shown as investment in P Limited's books, but we need to remove it for consolidated statements. And so when we remove it, we have to remove it from non-current assets. And equally, we have to remove it from share capital and retained earnings, because the next step is to add together all of the assets and liabilities. And once we've done this for each line, we've added together P Limited and S Limited's assets and liabilities, we'll have incorporated the net assets of the subsidiary into the group. Okay, so this is a step that does the incorporation. If you don't eliminate investment in S from the investment or the share capital and retained earnings, you will have counted the value of the subsidiary twice. So step two is just to add up each line. So 320,000 plus 80,000. We add together this line. Well, 100,000 less 100,000 is 0. So we won't put anything there. We've eliminated that line. We are adding together 150,000. We're just doing this line by line, adding everything together. Of course, here we're not adding the subsidiaries, share capital or retained earnings, but we do down here add together the liabilities. So it's just assets and liabilities we're adding together. And so finally, when we go across each line, we add 30 plus 20, we end up with 400,000. 100 less 100, 0. We've eliminated this line. And so now the non-current assets of the P group are 400,000. Okay, so can you see what's happened there? 400,000 is the property, plant and equipment for both companies. That's all we want for non-current assets. If we hadn't eliminated this line, we would have had 420,000 plus 80,000. We'd have had £500,000 for assets, but that wouldn't have made sense because part of this £100,000 investment includes the £80,000 of non-current assets. So you would have counted this twice had you not eliminated the investment in S Limited. So 400,000 is what we have for non-current assets. And we do the same line by line. So inventories, we add those together. We have no adjustments to make. So we're just adding together inventories. We get 150,000, we get 90,000 for trade receivables. We get 300,000 for cash. And then we can summarize or surmise these lines by adding what is above it. And it is important that if you use this consolidation matrix method, that when you get to a summation line, as we have here, in this column, you add what's above it or subtract what's above, not adding these two together. Because if you added these two together, you're not going to have the impact of any of the adjustments we've made. So it's important that when you get to a summation line, you do the summation of the lines above rather than adding together what's on this side. So in total for non-current assets, we get 940,000. Which is what we would expect because here the 800,000 of P Limited's non-current assets includes a £100,000 investment in S Limited. We've effectively removed that. This is effectively reduced to 700,000 plus 240 is 940,000. We do the same thing with equity and liabilities. So effectively eliminating the share capital and retained earnings for the subsidiary, giving us just the share capital and retained earnings for the parent. And in total, we have 400,000. And then we have our liabilities. There wasn't a lot going on in liabilities, so they remain relatively unchanged. So that's how you do a basic consolidation. That's the basic principle of removing the investment in the subsidiary from non-current assets and also from equity accounts, the share capital and retained earnings. So if you found that video useful, we have many more videos like that one on our YouTube channel. So give this video a like and subscribe to the channel if you want access to more of that content. We are also
around in other places on social media. We have an Instagram page. We are available on Twitter, and we have a number of Facebook groups related to which particular level you are at. So if you're an operational student, have a look for our operational group where you'll find useful content there. And of course, you can find us at our website, www.astranti.com, where you can get access to many free materials.